On today's Hot Sheet, I'm discussing this week's FOMC meeting. It's Jerome Powell Day. His statements on housing during the press conference, where future rates might be heading, the Fed's summary of economic projections, and the weekly unemployment report. Today is Thursday, December 11, 2025. I'm Byron Lazine, and the Hot Sheet starts now. Live from Naples, Florida, we've got a beefy one today. It's Jerome Powell Day. Of course, the decision from the FOMC was made yesterday afternoon. Following that, we had the Jerome Powell presser. Now, these are macroeconomic topics here that we're talking about. The Fed decision, how that's going to impact, obviously, rates, the economy, their projections, which they do quarterly. We're going to cover that, and unemployment report. These are all macroeconomic topics. And so what we're doing here on the Hot Sheet, what we do every single about 6 to 7 weeks when these Fed meetings happen, there's 8 of them, the FOMC meetings rather, there's 8 of them a year. This is the 8th and final one, obviously, of 2025. What we do is we look for the connections to how it's going to impact housing. This is the only show on the internet that gives you a 24-hour look back on the housing industry, on the market overall, the macro market, and these economic conditions that impact it. Hope you're subscribed by now. If you're not, hit the subscribe button on YouTube, hit the notification bell, and let's get into it. Glad to see everybody who's tuning in. It's a pleasure to be with you, and let us know where you're tuning in from. I love all of that. All right. Let's first look at the obvious. The decision was made. We knew this coming in, to go ahead and cut the Fed funds rate, the overnight borrowing rate, a quarter of a point. Now, it's important to break apart the Fed rate and what's going on with things like the 30-year fixed or the 10-year treasury, or other long-term rates. Certainly, this is an overnight rate. When in a consumer's mind, okay, the Fed rate has some to do with the 30-year fixed, obviously, in the long picture, long-term picture. They're not correlated here in the short term. What have we seen the last 2 meetings? We've actually seen the 30-year fixed move up after the Fed decision, because Jerome Powell comes out and, he's very hesitant to say that we're in a good place. He's very hesitant to say we're going to have future cuts. And the market responds to that. Remember, Jerome Powell does not care about the housing market. It's not a concern of his. The mandate from Congress is 2% on inflation, so stabilize pricing. Okay, and he wants to be seen as a Fed chairman in his legacy. People have egos. Humans have egos. Jerome Powell's no different. He doesn't want his legacy to be one that suggests he let inflation get out of control, I would say, again, because he let it get out of control at the beginning. So it's a Congress mandate of the chairman: stabilize prices, the target's 2%, and then maximize employment. Okay, so he's balancing those two. They're in conflict of each other right now, which is kind of a tough spot to be as a Fed chairman, about to be a lame duck Fed chairman as he ends his tenure in May. He's going to, there's going to be a replacement being announced. Obviously, anytime between now and call it mid-January are the indications. Okay, so they went ahead and made that overnight Fed fund rate cut of 25 basis points. What they did not do, and what was expected, is to come out and say, yeah, we're going to keep cutting. Okay, and so the markets have kind of caught on to this now over the last 3 cuts in a row. It comes out, tries to pour water on the momentum, and certainly does not want to see the housing market pick back up again. Every time he's been asked about housing in the past, not every time, but a lot of times when he's asked about housing in the past, like, hey, you want me to have a concern about housing? Talk to Congress, make it a mandate for the Federal Reserve. We don't pay attention to housing. They don't care if 100% of people rent. They just don't. Fed does not care about the housing market. In fact, prefers, in their fight on inflation, for home prices to probably go down, for people to continue to, to have subdued activity on housing. Okay, that's how the Fed would look at it. Now, how is the Fed looking at during the press release here yesterday, how are they looking at the overall economy? Okay, the first line here, very interesting. Available indicators suggest that economic activity has been expanding at a moderate pace. Now, remember, Jerome Powell and the Fed was very hesitant to say this at the beginning of the year. When Trump version 2 got inaugurated in January and started going hard on the tariff talk, that scared Jerome Powell, scared the Fed. They did not want anything to do with tariffs. It brought on uncertainty. Remember, first half of the year, what was Jerome Powell's favorite word? It was uncertainty, uncertainty, uncertainty. We don't know what's going to happen with tariffs. This could inflate inflation and bring inflation back, and they don't want to see that. And so they also used a lot of language around the heart of the tariff and trade war time, and be thinking about April when the stock market dropped there. It was a great buying time, obviously, when the stock market shot right down, when the market was even reacting along with Powell to this uncertainty with what's going on with all these trades. It seemed, it was very wild time, something that the markets and the economy hadn't seen before. And Jerome Powell often said, this is, we're not projecting economic growth. We think this is going to cap economic growth. Now, because there's more data, there's a year of data in, you've seen the deficit go down, and deficit by some reports is down to almost 2019 in terms of, instead of adding to the deficit has moved down. Inflation still obviously having a concern, but the economy has continued to grow. We've seen that in the GDP numbers. So for that to be the first line, I thought was interesting. Now, job gains, they go right to jobs. So acknowledging economy activity, it's been expanding at a moderate pace. Job gains have slowed this year, and the unemployment rate has edged up through September. No longer during this conversation here yesterday was Jerome Powell calling unemployment low. Okay, we've heard that a lot throughout the year. And then the last couple probably months, we've heard, we're watching unemployment and no longer using the word low. So unemployment, we're going to look at unemployment weekly numbers at the end here today. But no longer using unemployment is low. Now, historically, it's kind of like, it's kind of just right in line. And so, look at the overall picture this year and where we've certainly been the last couple number of years, unemployment low historically. Now, so why are you not seeing unemployment kind of edge up? That's one of the those interesting parts. It's like, people are losing a job and then maybe not going right into unemployment. Jerome Powell was actually asked this question. He's like, I don't know why unemployment's going up. So that tells you that they expect maybe some future bumps in the road on unemployment, maybe for some pops. The weekly, maybe we had a Thanksgiving holiday, maybe we'll shed some light on that. We'll need some more weeks of evidence before we get to that. Recent indicators are consistent with these developments. Inflation has moved up since earlier this year and remains somewhat elevated, right? If inflation's tracking in the high 2s or 3, depending on what you're looking at, that would be somewhat elevated versus the 2% target that the FOMC, obviously, and Jerome Powell have. Okay. So the quarter percentage cut to the 3.5 to 3 3/4 is where they're at. That's the decision that they made. Okay. So this is the third cut in a row. Now, what we're going to get to the projections here in a little bit, but I'll tease one of them out. The SEP, they do this every quarter. And in that projection, the Fed is only looking at a cut of one time in all of we just had 3 in a row, one time in all of 2026, the median projections here from the FOMC, and one cut in 2027. So by the end of 2027, trying to get to that 3% range on the Fed funds rate. We're only at 3.5 to 3.75, so we're not that far from it. Okay. Now, this vote was very interesting because for the first time since the early 90s, you had a 9 to 3 vote. Okay. So this was a dissenting vote. It's very rare that everybody's not on the same page. The vote was 9-3. Governor Moran favored a 0.5 point reduction. Remember, Moran was appointed by President Trump. So, Trump political opponents would say that things like I heard Elizabeth Warren, for example, on CNBC this morning saying, people like Moran or the potential lead for the Fed chairman, these are people that are doing the president's bidding and pushing for these these larger reductions. At the same time, Elizabeth Warren says she wants a lower rate. So I don't understand. I think that's just politics and hate, right? But regional presidents Jeffrey Schmid and Kansas City, Austin Goldsby of Chicago said no cut. Okay, so you got the Kansas City Fed governor and the Chicago Fed governor saying no cut. So those are the 3 dissenting votes. The other 9 votes all supported this 25 basis point cut. Okay. It was the 3rd consecutive no from Moran. And then it was the 2nd straight from Schmidt. So they basically vote yes or no on a 1/4 point. That's what the options were. Moran says no. The other 2 say no because they want to hold the line. He wants to go Moran, that being a 0.5 point. The previous 3 dissent meeting also featured a 2-to-1 divide. And so you can see that the Fed's not on the same page. You can see that quite frankly, politics are leaking in to the Fed. Now, they've always leaked in. Even if you want to believe that they haven't, they always have. You can point to a lot of different moments in history there. So this is where we're at. And this 3% line here, slightly above where we were in, say, 2017 to 2020, or 2018 rather, to 2020, those 2 years. We were kind of just under 2.5. This 3% is the target over the next couple of years based on the projections, which we'll go through here shortly. Obviously, following or during recessions, as you've seen, that's when you get those steep cuts. And so we're getting that right now without, I know it hasn't been as steep as obviously 2020 or as steep as the GFC or during the .com recession. Right. We held for a while here and then continuing to cut. But this is quite a bit of cutting without one of those gray bars here. The recession, typically the cuts happen before the recession ensues. So this still leads you to believe that the possibility of the big R word is out, based on the actions that they're taking and the concerns that they have about the job market. Okay. We've got Jerome Powell's prepared statements, which he read as a transcript off before the press conference. And then we've got the timestamps, particularly when he mentions housing, and those housing mentions one time in prepared statement, and then housing mentions you had 3 questions. I think there was, I want to say 14 or 17 questions, somewhere in that range, over about a 45-minute presser when he took questions. And so 3 of those related to housing. Okay. So Fed Jerome Powell says we're well positioned to wait and see how the economy evolves. These 3 cuts, he believes, has put the FOMC, the Fed Reserve, in a position to now wait and see what goes on with the economy, get more data on jobs. He pointed towards the shutdown being a hurdle that they have to overcome because they have lagging data on jobs. Go to the quote, we're in the high end of the range of neutral. So remember, neutral would be that 3% number that I just showed you. 3.5 to 3.75 right now is the Fed fund target, is the high end of neutral. So no longer using the restrictive language on on where we are with federal interest rates. It's just so happened, he says, that we've cut 3 times. We haven't made any decision about January. But as I said, we think we're well positioned to wait and see how the economy performs. That's an indication that during the end of January, during that January meeting, that there will not be a cut. Polymarket right now, who is right on the money, obviously, with this cut, as with CME Group, are both weighed heavily into the camp that there will be no cut in January. Going back to the quote here, the discussions we have are as good as any we've had in my 14 years at the Fed. So, really talking about, hey, we're having great discussions. Very thoughtful, respectful, and you just have people with strong views, like the half a point view versus the quarter point views. We come together and we reach a place that we can make a decision. Okay, so during his opening statement, only mention of housing was consumer spending appears to have remained solid, and business fixed investment has continued to expand. Okay, so again, alluding to economy that is moderately expanding. That is good news if we're going to avoid a recession. Okay, that the natural definition of a recession would be 2 consecutive quarters of negative GDP growth. We had one of those in the first half of the year, and then we've seen economic growth since that time point. Okay. But he says, in contrast to that economic growth, activity in the housing sector remains weak. Remember, as activity in the housing sector not being a mandate of his, and it helps the inflation concerns. A housing sector remaining weak makes Jerome Powell smile. Okay, the Federal Reserve, based on their mandate from Congress, even though Congress complains about affordable housing, they don't care about housing. So it makes him smile in the background. He wants the housing sector to be weak. It makes his job easier. Okay, so in contrast to a growing economy, which helps maximum employment, that is a mandate of his, housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. So he's already calling for higher economic growth. We're going to look at their projections on where they're seeing economic growth here in the future. But before we get to that, SEP, the statement of economic projections from the Fed, which they do every single quarter, let's go to the housing mentions. Let's go to the Adam Schefter of the Wall Street Journal. This is the guy that gets a lot of, if any insights from the Fed are shared, it's usually with Nick Timmeros. Wall Street Journal, he asked a question. Let's go to the Q&A from Nick T.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years. And indeed, the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to
I just pause him before we go to Powell's.
The idea is that
pause him there. Okay, so what I like about this question is like, hey, because people, everyday people, our customers, you can go to the big screen here for a second, then we'll go back to Powell. Our customers, our clients, everyday people, what they're concerned about is their job, the prices that they're paying, and can they afford a home? Do they have a great place to live? And what Nick T's saying is like, hey, especially as it relates to small businesses, everyday people, like, what gives you confidence that, unemployment isn't going to take off in 26 when housing and other rate sensitive sectors, like a long-term rate for, you go do a commercial deal or, small businesses, these are not great rates for them. It's restrictive. Go buy a home at the prices they're at right now on the 30-year fixed rate. I know it's under the 50-year average, but this is feels like a restrictive policy based on where those rates are, the everyday rates. Even though you've got the 150 basis point cuts prior to today, This is what they feel on the other side, Powell. And so let's go to his answer here.
With now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Okay, so remember what his out cards are. He'll bring up tariffs. Obviously, is like, hey, I could be doing a better job if it wasn't for tariffs. Remember, Jerome Powell does. I mean, long term, he's acknowledged in the past, like, we have to do something about our deficit. These tariff and trade policies have made the biggest impact on the deficit since 2019, which is interesting, but it's not one of his mandates. So he's not focused on the deficit here in the short term. He's focused on the mandate from Congress. Ultimately, the third thing he'd be focused on is his personal legacy. Again, he is a human. I get it. And so again, the policy is not accommodative. It's not restrictive anymore. He's used restrictive language in the past. He's calling this more higher end of neutral. Doesn't believe that unemployment's going to tick up more than 1/10 or maybe 2/10 because of where the policy currently is. Didn't really address the housing sector part of Nick T's question because he does not care about housing. Go to Christine Roman's NBC News. And this is towards the later half. This is in the second half of the presser. So you had a lot of questions before this that ultimately were about jobs. Let's go to Christine Roman's NBC News on her question that had some relation to housing.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than 1/3 of the consumption, for example. So, it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
Yep. The dual mandate. So this one's interesting because it also speaks to something else the Fed is going to start doing on tomorrow. In fact, they're going to start quantitative easing, QE, obviously, and which you've heard about. And, you know, they stopped QT, quantitative tightening, and now they're going to be into QE. Now they're not, you know, where they have basically infused asset prices in the past when they were easing and buying up, you know, mortgage bonds and long-term 10 and 30-year bonds. Okay, what they're not doing that this time. They're buying up these short-term T-bills, you know, real short-term, couple months, 4 months, those kind of things. And so the reason why I'm bringing that up here is because he's talking about like this, you know, they're talking him and the question from Christine. It's like these higher income. Okay, so who gets helped when they're doing these short-term, basically bringing more liquidity into the market with these short-term T-bills the most? It's money market funds. It's the U.S. Treasury. It's banks. It's investors. Okay. Now what does not benefit is, you know, like in some of these big recovery moments, you'd have a benefit to long-term mortgage rates, which is a bigger impact on everyday people. Well, remains, you know, long-term rates do not get impacted. Okay. So not affected. Long-term Treasury investors, mortgage rates, real estate borrowing costs. So you're not going to get help there. You're not going to get a tailwind on this step in quantitative easing. And some of those, you know, the banks have more liquidity and kind of keeping status quo going a little bit. I would say in these times of uncertainty with where jobs and inflation are going, and you know, whether that's the right decision or not, obviously remains to be seen. There's a follow-up question from Romans. We'll go to that.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, you know, a 25 basis point decline in the federal funds rate is going to make much of a difference for people.
Pause it.
You know, housing supply is low. Many people.
It's not going to make any difference. I think that's the punchline. That's what we've seen here all year. In fact, when they make these 25 basis point cuts the last two times, we've seen the 30-year fix go up. Now, we didn't see momentum on the 10-year and the 30-year fix in the couple weeks leading up to this meeting, so maybe we kind of hold firm. But this is the really important punchline as people are seeing headlines right now. The Federal Reserve cut for a third time. Man, I'm gonna get a better interest rate, and they get disappointed when they talk to their LO. They get disappointed in their agent who introduced them to the LO. This guy's trying to screw me. He's giving me a higher 30-year fixed quote than I got 3 months ago, and the Fed's just cut the rates. And so these are two different things. And Jerome Powell said it right there. This doesn't help make a difference for people who are buying homes. Okay. Go back to the rest of his answer. He starts off, housing supply is low, and then we'll pick up there.
Have very, very low rate mortgages from the pandemic period, and they kept refinancing and got the really low. So it's made expensive for them to move. And, you know, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem. And, you know, really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, you know, a secular housing shortage.
All right. So really putting the onus on who can have some impact from a federal government standpoint on what happens in housing is putting it back on Congress. Like, hey, there's a structural housing shortage. Maybe you can address that with some deregulation. I mean, he didn't use those words, but, you know, the obvious would be to help make building affordable for builders. Regulation and the time it takes from shoveling the ground to building would certainly help in that arena. He also said in the middle there, where we are in this real estate market right now, we're a ways away from that changing. That would reflect what the recent Realtor.com projection is for the next 12 months. If we're a ways away from the environment we've been dealing with here for the last 3+ years changing, suppressed transactions due to how many people, when they were quantitative easing at the degree of buying mortgage bonds and long bonds, and everybody got 2.5% and 3% rates. And it's very expensive for them to move, and they're holding, and homeowner tenure is increasing because of that. If we're a ways away from lower transaction count, an increase in these rates, affordability being, at an extreme unaffordable spot, for and inventory and really kind of new construction priced in a range at which is affordable to more of where the demand is, if we're a ways away from that landscape changing, then it points towards Realtor.com and other projections being kind of dead on for the next 12 months. Realtor.com says right where we are today, and this is where we ended the day yesterday on the mortgage read, on the mortgage print. We ended yesterday at 6.3. That is the exact number that Realtor.com is projecting as an average, 6.3 for 2026. And it's the exact number that Realtor.com projects we will end 2026 at. Meaning the market takes seasonality out of it. Obviously, February, March, April are gonna be more active than December when we're 14 days away from Christmas. I get it. Santa's about to drop down the chimney and people are thinking about other things. Got it. Okay. But this 6.3 environment on the overall scale that we're dealing with right now, this is what it's going to be for the next 12 months. If that Jerome Powell statement is true, we're a long way away from seeing a change. If Realtor.com's projection is right. And so if all of these things kind of sit in line, that's where we're going to be at. Another year similar to the last 3 years, or very similar, I would say, to this year in particular, because like Lance Lambert shared on Knowledge Brokers Pod in the past, you kind of replicate the last year. Tomorrow on Knowledge Brokers Podcast, Danielle Hale, the chief economist who made that projection along with her team at Realtor.com, is coming on the pod. So we're going to ask her why they came up with that number, how they got there, what it would take to get a lower number. Is there any chance of that happening? We're going to ask all those questions. We're going to pick through how that projection came to be. Knowledge Brokers Pod, Haley, link it up. Make sure you go subscribe. That'll be out tomorrow midday, somewhere in there, so that we can break through all of that. All right. Now we get their summary of economic projections. I told you this is beefy. This is macro. I get it. But we got to get through it here. So we got the summary of the economic projections from the Federal Reserve. Okay. So we've got the September projection, and I want to focus here on GDP first. This is gross domestic product. This is kind of like, hey, is the economy expanding or retracting? And this is kind of where you look into, like, do they believe we're going to have a recession? And their change in real GDP. So they're now projecting a total of 1.7 for this year, where in September they were at 1.6. So they ticked that up a 10th point higher. Now, the change in real GDP for next year, they've moved up an entire 0.5 point. So they've got a run of 2.3 for 2026, where just 3 months ago, the data that they were looking at suggested only 1.8 on the economy's growth on GDP. So a 0.5 point is sizable because you're getting 12. They're using the median of these 12 members of the committee. And remember, you've got a dissenting committee, but on the overall, they're looking at the data together and they're saying, hey, the economy is going to grow at a 0.5 point more next year than we thought just 3 months ago. So, yeah, I mean, some of the concerns we have about inflation with trade deals and tariffs, it is expanding the economy. It's been on exports. And so they're seeing that data and bumping that up. 2027, in line with where they were in September, just a 10th higher at 2% off of the 1.9, in 2028, 1.9 versus the 1.8. So they're not very bullish long-term about a lot of growth. And so that's kind of where they're at on GDP. Now, we look at the unemployment. They're calling for a 4.5, which is, where they were calling projection last month. That's where we're at. That's what they're saying here for the year, 4.5. Next year, they say it's actually going to move down overall. So even if it ticks up here in the short term, they're projecting a 4.4 unemployment rate for 2026, and then moving to 4.2 the following 2 years. So unchanged from September on where they think unemployment rate will land in 26. PCE, this is interesting. This is their favorite inflation metric. They meaning the Fed. And they've actually moved this down from 2.6 in September to now 2.4. So remember, the last couple of reports we've seen on inflation, hey, a little bit lower than expected, a little bit lower than expected. The data's lagging, so we got to be careful. We got to sprinkle in some uncertainty, obviously. But, the Fed, who has been slow to acknowledge that, hey, maybe tariffs trade have not been as bad for inflation as the initial concerns. Remember, the initial concerns were that we would be, and a lot of these were, I get it, were some partisan analysts, obviously, kind of being influenced by politics. You always have to take that with a grain of salt. But remember how many, in April, it was like, we are going to go into a deep recession. We're not going to be able to recover. The sky is falling. The stock market's going to go to zero. We had some of these comments, right? And so to be now at the end of the year and kind of see, okay, well, yeah, there might be some things that are obviously higher cost. Inflation's always going to go up forever and always. A 2% target means prices go up forever and always. You're not ever getting back to 2019 levels. You've broken a new price level. Okay, we get all of that. But now for the Fed to kind of just say, hey, the data that we have right now, in 3 months, we've changed our tune on inflation to be improving at a better rate than some of our concerns, even the concerns they had in September at 2.6 versus now 2.4. 2.4 be pretty close to the target. And they say we're not going to get to exactly the 2% target until 2028, 2.1 in 27 and 28 are in line with action. Core PCE inflation at 2.5. That is a tick down, a 10th down from where they were projecting in September. Now, this is where the projections are interesting because we're at 3.5 to 3.75 on the federal funds rate. And they're only projecting 3.4 is where we're going to be for 2026, which means they're basically on the median projecting one more cut between now and this time next year. Okay. So like you got all your holiday gifts now, these last 3 meetings. If you're looking for cuts, and you're going to get one more, okay, between now and this same time next year. And to me, the best, this is the best news out of the projections, that overall the FOMC feels better about inflation than they previously did. So here's that famous dot plot. I mean, we just looked at it in pure numbers, but this is kind of how they come up with this stuff, because they don't want to give you the names of who wanted what. And for like, if you look at this one, this is going to be Moran. Okay. He's the only guy that wanted the 0.5 point. And then he wants it to go down to this 2 to 2.25 range, 2% range in 2026. Again, the consensus is right about here, more of that 3.4 range. And you've got some that actually want, you've got 3 or at least 3 dots. So 3 of the 12 members here. And actually, there's more than 12 members because you got the 12 that actually make the final decision, but you got about 15 or I'm sorry, 18 or so that are actually doing the SEP. And you have 3 of those 18 that would like to see a Fed fund increase on the overnight rate next year. So a lot of different views there. We're obviously going to see a newly influenced FOMC as the new Fed chairperson is announced, maybe the end of this year, maybe in January. Powell's tenure up in May. The president, Trump, has been very clear that he's being replaced, and we'll see what happens there. For long-term expectations for our clients, I think you have got to go with what data we have right now. You've got projections that support it. You've got Jerome Powell's own statements himself. You've got reactions now over the last 3 cuts that rates don't really move, that rates are going to stay elevated over the next 12 months. If you're making a 2026 decision, you're making it north of a 6%, in all likelihood, 30-year fixed rate. We know the market opens up if we get a 5 handle and confidence goes up. But you're going to have a harder run on the housing market improving over the next 12 months versus an easier one. It's going to feel more like this year than any kind of, year where you had a tailwind. And that's what we're heading into. And that's certainly what we're heading into here for quarter one, outside of some major macro changes. And that's the expectations that need to be set with customers. There's tons of evidence over this year. We've covered it all to point towards and help them understand. You can simply just go to, and then I'm going to get to the unemployment here. You can simply just go to, where these, look at this. This is the last meeting. Okay. Before the last meeting, the 30-year fix was 6.13. And then what happened? It shot up the 30-year fix to 6.33. The meeting before that, 6.13, we hit, and then it shot up to 6.3. So we've been kind of, holding at this 6.3 range. That's the projection. The good news is we're off of the, 7.3 topper that we saw in the beginning of the year in January. So we've come down a full point. The goal would be at least to stabilize here. Obviously, the overall goal would be to improve. But what the Fed does has not impacted rates in the short term. You've seen these go up. Yesterday, you actually did see it climb down from 6.35 to 6.3, but you didn't have the momentum going into the meeting that we've had in the past. You're getting a little bit of momentum right now on the 10-year. So the 10-year was maybe a little bit concerned on maybe, how restrictive Powell would sound. And 10 years maybe come back to a better place here, 4.116. Remember, yesterday, it actually had hit 4.2 over a 24-hour period yesterday. And so if we look at the last 5 days, we're at the low end of the range. So that's improved. If we look at the last 3 months, last 90 days, we're still at the high end, but settling back here just over 4.1 on the 10-year. Okay, where did unemployment land with this week's release from, obviously from the Department of Labor? We came in at a really low number last week, which was 191,000. And this week it pops up. The week ending December 6th, initial claims was 236,000. So you get on the other side of the holiday, you see an increase here. It's an increase of 44,000 from previous week's revised level. You're supposed to have, obviously, holiday adjustments, but you do see a sizable pop, 44,000 to the upside on weekly unemployment. Last week's was revised, the previous week anyway, to 192 from the 191. The 4-week moving average is 216,000. So 20,000 above the 4-week moving average. And really, we'll be looking at this number next week to see, if we're now getting consistency on that elevated number. You got to get north of 250,000 for this really to start to raise a yellow flag on, is unemployment rate going to potentially move up? So a move up on a week to week, nothing we haven't seen throughout the year. We've seen this level at plenty of time. 216,000 is the 4-week moving average. You look for that to get up over 250,000 for some of the alarm bells to maybe start going off. And we haven't seen that. We're not close to that right now. We'll look at what it is, obviously, next week. As we look now, 6 weeks or so out to January 27th, 83% chance that there will be no change. Interestingly, Polymarket is riding a 17% chance of a 25 basis point cut. I would have expected that to be lower. So the money says 83% no change on the next meeting. Okay. All right. There you go. If you want kind of the data bank of all the history that we talk about here on the hot sheet, just jump into the hot sheet classroom on school inside of school for BAMX members. And we've got all the data, all the slides that we use, as well as the hot sheet show notes. And that's available for you. If you get somebody super analytical, kind of really needs to understand what the next 12 months looks like on the rates. Nobody knows. I'd be, if I knew what was coming, I'd be sitting at the Wynn in Vegas right now and doing this show from the hotel room before I go down and place a whole bunch of bets. We ultimately don't know, but we got a lot of data here to suggest that the housing market is still going to be in a restricted place. I mean, Powell says it. The projections that I buy into, like a Realtor.com, suggest it. And so that to me is kind of where we're heading. A little bit of a breeze, maybe, just on people like saying lifetime decisions. I'm sick of waiting, but certainly not a tailwind heading into 2026 under no conditions. Tailwind would have been high fives. We're not going to get there. We're going to talk about all of that with Danielle Hale over on Knowledge Brokers Podcast tomorrow. Make sure you sub up to Knowledge Brokers Podcast wherever you listen to pods, whether it's Apple or Spotify or a separate YouTube channel. We're going to break down what those projections mean and ultimately how could they improve throughout. What would have to happen? Do we even want what would have to happen? We're going to talk about it all with the Realtor.com chief economist tomorrow on Knowledge Brokers Pod. I will see you guys over there. Walk through up later today on the main channel. Until then, of course, have a great day and toodaloo.